Crude prices ticking a bit higher this morning after Iran sent a warship into the Red Sea, escalating tensions there. Joining us now, Kevin Book, ClearView Energy Partners Managing Director of Research. Kevin, good morning. This has been an interesting market in crude. We've been through, obviously, the Russia-Ukraine war, clearly the Israel-Hamas war as well. No kind of enduring geopolitical premium seems to have stayed in the price, at least not that we can really discern. Seems like supply is overrun a lot of that. Do you expect any of that to change?
Well, there is definitely some room for risk to the upside. If you look at where we are right now, we're seeing a small rise, as you say, a muted one in response to an Iranian warship in the Red Sea. The risks that are out there, though, go further. They include adjacent waterways, the Strait of Hormuz. Iran made a threat last month, even into the Mediterranean. And then there's, in our hemisphere, the ongoing potential conflict later in the year between Venezuela and its neighbor, Guyana, which is one of the biggest sources of the incremental supply that's been muting those geopolitical responses.
If you are generally bullish on oil, anybody, I'm not saying you, but if you're bullish on oil and you're resorting to the world's a messy place, there could be conflicts, and who knows what happens to supply or transport. I mean, it seems like a little bit of a position where you're starting in a little bit of a hole because you're counting on the market to kind of extrapolate the potential impact of something, and we don't exactly know if it's going to come through.
Well, looking ahead, my colleague Jacques Rousseau projects that we're going to be slightly a little bit tight, maybe 100,000 barrels per day first quarter demand ahead of supply. And where there's big difference is really in the statistical agencies that look at the world. The IEA has a much more modest demand projection looking ahead at the year than OPEC. And you can say, well, OK, OPEC must be talking its book. A producers group sells oil. Why would they not be bullish? There are 1.5 million barrels per day of demand to the upside relative to the International Energy Agency. If that is right, then the market is much, much tighter than it looks right now coming into the year. And so I think that demand uncertainty probably is still worth considering. A faster recovery, maybe we're seeing more demand in non-OECD chemicals, jet fuel, some of the transportation fuels on the roads. Maybe not here in the developed world, but globally, still plenty of people want to drive, fly, and move.
Yeah, no, there's no doubt about that maybe there could be a surprise to the upside on the demand side. But again, this is a global market where you have, spot rates mostly determined by who needs the commodity now and who can supply it. And so you think that the potential differences in, the inventories or the demand projections are accounting for a potential edge in trading it?
We're seeing, again, risk to the upside because of geopolitics, but a balanced fundamental market. So, no, I think one story that we saw very clearly in 2023 is that the electric vehicle demand destruction story has yet to play out. Every million electric vehicles on the roads here in the U.S., where we drive a lot, is about 30,000 barrels per day of demand destruction at the sort of the upper bound. So how many millions you need to rack up before you really see the end of oil demand? I think still too soon for that story.
Yeah, although, I think you could not even go that far and say miles driven are been pretty stagnant, I think, in the U.S. at least. And then, of course, we have U.S. production and other Western Hemisphere production, which seems like it still continues to be relatively aggressive at this point.
Yeah, there's no question that if you look at the sort of the last week of EIA data from the end of the year, it's 1.3 million barrels per day, year-on-year growth, almost all of it from the lower 48. And so, yeah, you can't overlook the importance of the shale growth that we've seen. We also have to ask, what does the rationalization of a merger wave mean? The long-term story is probably more production growth, yes. But the near-term story, when you have a merger, 10 BTUs walk in and 8 walk out. So maybe a little bit of rationalization to come.
You've mentioned a few times, potential risk to the upside. Where do you project that prices will go, crude, let's say?
Well, ClearView, we long ago stopped putting price projections on paper. It's an errand we don't pursue. But up from here, relative to where we stand, we've seen 2% moves so far, just on one warship and 3 helicopters, or three fast ships taken out by U.S. helicopters. If we get to attacks in the region on Yemen soil, from the U.S. and allied forces. More room to the upside, well into the 80s probably. But there are limits, of course, again, based on the supply story that you've been talking about. And so realistically, the question is whether we have disruptions or just risks. If it's just risks, we see this over and over again. It was 4 years ago, really today, to the day, that the U.S. Killed Qasem Soleimani, the head of the Iran's Islamic Revolutionary Guard Corps Quds Force. And we saw relatively modest moves to the upside then, too. First quarter is a time of relative demand weakness relative to the year writ large. And if you think about the market looking at regional risk with memory of 4 years ago, it may be working on that sense memory. So if you don't actually see a disruption, these things do die out relatively quickly.